People often say, if Bitcoin isn't going to zero, it's going to the moon. It can either become worthless or something huge. Right now, it's clear it's not going to zero. Major financial companies like Fidelity, Citadel, BlackRock, Charles Schwab, Deutsche Bank, and many others are all showing interest. These are not the type of companies that bet on silly ideas. They're investing in something they believe will grow. Once people stop thinking of Bitcoin as a scam and start seeing it as a real asset, the next question is, what is it actually worth? If Bitcoin grows to become just 1% of all the assets in the world, its price could multiply by 10 to 20 times. That's how powerful small adoption can be. A few important things are helping Bitcoin gain trust. The first is the launch of Bitcoin spot ETFs. This allows people to invest in Bitcoin like a stock. The second is improved accounting rules, which make its value easier to track. The third is the halving event, which happens every 4 years and cuts the number of new Bitcoins in half. These events build more interest and trust in Bitcoin. So why should a normal person care? Well, think about saving for retirement or your children's future. You might open a savings account. It offers 5% interest, but inflation is around 7% or more. That means in reality, your money is losing value. After 100 years of saving like this, your $1 million might only be worth $30,000 in real terms. It feels like you're saving, but you're actually going backwards. Inflation quietly eats away at your efforts, making it harder to achieve real financial freedom. This is one reason why traditional saving strategies don't always work in today's economy. The real challenge here is that many people believe they are saving, but in truth, they are just losing money slowly. It's like filling a bucket that has a small hole at the bottom. No matter how much water you pour in, you keep losing some of it. Some people invest in bonds instead, but when bonds give only 3 to 4% interest and inflation is higher, that's also a losing game. Over generations, families lose 90% or more of their wealth if they rely on low-interest savings or bonds. It may look safe on the surface, but in the long run, it's a slow drain on your wealth. Bonds might be less risky in terms of short-term losses, but they carry a huge risk of long-term erosion. Many people don't realize this until it's too late. People don't always see the loss right away, but over time, it becomes clear. Their buying power drops, and their hard-earned money doesn't stretch as far. It becomes harder to afford essentials, much less luxuries. What about putting money into the stock market like the S&P 500? The average return of the S&P is about 7%, which also matches inflation. So yes, your wealth might stay the same, but you're not really gaining anything. You're just maintaining it. And that assumes the S&P remains strong for 100 years, something we can't guarantee. Stock markets can be volatile, and crashes can wipe out years of growth. Even seasoned investors struggle with timing and market shifts. Relying solely on the stock market can be risky if you're looking for long-term certainty. Markets can crash, companies can fail, and the financial world is not always predictable. Even major firms that once looked unshakable have gone bankrupt or lost huge amounts of value. Maybe you think real estate is better. Buying land or buildings sounds good, but the average person can't afford to buy a large building or a block of warehouses. Rich families can. The middle class can't. Even if you invest in a real estate investment trust, REIT, you don't own the building. You just own a small piece of it. It might feel like you're part of something big, but in truth, you're far from actual ownership. Your control and benefits are very limited, and the profits are shared with many other investors. And there are still fees and taxes that chip away at your returns. And that's a problem. When you own a share of a right, you have no control. You can't sell or renovate the property. You're just along for the ride. If the people managing the REIT make bad decisions, you lose money. You don't get to vote. You don't get to fix anything. You're just stuck. You're relying completely on someone else's judgment. If they fail, your investment fails too. There's very little flexibility and no real way to protect yourself. Plus, property ownership also comes with local risks like natural disasters or changes in zoning laws, which can suddenly decrease the value of your investment. That brings us to another issue: ownership rights in stocks and securities. When you invest in a company like Apple or Google, you don't really own part of the business. You own a share, and that comes with risk. First, you have a management team that takes fees, usually about 1%. That might seem small, but over your lifetime, it adds up. Paying a 1% fee every year over decades can reduce your total wealth by up to 20%. These costs quietly eat into your profits. Many people don't understand how much they're losing because it happens slowly over time. These fees are often hidden or not clearly understood by new investors, making it hard for people to know exactly how much they're paying. Next, you have labor risk. What if the company's workers go on strike or demand higher wages? That eats into profits. Then there's competition. New companies can release better products and destroy old ones. Think about Kodak, AOL, Yahoo, all giants that got replaced. Business is a fast-moving world, and it only takes one breakthrough from a competitor to shake things up. Customers are quick to switch to better alternatives. Even loyal users may move on if something new offers more value. That kind of shift can happen in just a few months. You also have technology risk. A company selling oil might go down if people switch to solar or nuclear power. A camera company can die out when phones start taking better photos. Nothing lasts forever, especially in tech. Then comes execution risk. What if Apple releases a bad iPhone model? What if Coca-Cola brings back another version of New Coke that people hate? A single bad product can damage a brand for years. And there's always outside risk: wars, tariffs, or politics. Maybe your company relies on factories in China and a trade war shuts them down. Or maybe war breaks out and your asset is destroyed or seized. These risks are real and constant. So while you're hoping to grow your money by investing, all these risks are quietly working against you. That's why even the S&P just matches inflation. It's not truly growing, it's just staying alive. Now imagine there's a better option. What if you could invest in something that doesn't get outdated, isn't managed by people, and doesn't depend on factories or governments? That's where Bitcoin comes in. Bitcoin is a digital asset. It doesn't wear out. It doesn't have a CEO taking a bonus. It's run by code, not by people. There's no union, no factory, and no warehouse. It's just software, and no one can create more than 21 million Bitcoins, ever. When you buy Bitcoin, you're owning 1 out of 21 million of something permanent. There's no way to dilute it. Unlike the dollar, which governments can print more of, no one can print more Bitcoin. That makes it strong. Think about how technology changes. Today it's iPhones, tomorrow it might be brain implants. But energy never goes out of style. Bitcoin is like pure energy, digital energy. It's an idea that cannot be broken, and the way Bitcoin was created makes it even more special. The founder, known only as Satoshi, gave away the coins and never kept any for himself. There was no secret sale, no special advantage. It's one of the fairest systems ever created. It belongs to everyone. That's why it's so hard to copy. No other crypto has the same history. Bitcoin was the first, and it was given freely to the world. That's powerful. And unlike companies or real estate, owning Bitcoin doesn't come with taxes, repair costs, or tenants who don't pay rent. You don't need to clean it, manage it, or pay someone else to run it. You just hold it. If Bitcoin miners fail or companies working with Bitcoin shut down, you still own your coins. The network keeps running. Just like how McDonald's doesn't take the risk of each restaurant, Bitcoin itself doesn't carry risk from miners or banks. You do not lose your Bitcoin just because others failed.